Hello, everyone, and welcome back to the all-new Blueprint Strategy course. Welcome to Module 2, Supply and Demand and Fundamentals for Market Setups. In the last two sessions, we started and finished with Lesson 1, and today we're going to start with Lesson 2 of the second module, which is Location and Fundamentals. Before we start to talk about location, though, I first want to show you an overview of the entire supply and demand process. There's going to be 3 steps within the supply and demand process, and these 3 steps of the process involve a multi-time frame analysis. All of the steps that we'll undergo aim towards measuring, tracking, and optimizing our key KPIs, which are risk to reward and win to loss. How exactly that can be achieved, we'll talk about a little bit in terms of contextual understanding, but of course, towards the end of this lesson and towards the end of each lesson going forward, there'll be a lot of practical applications to drive home all the teaching points that I'm mentioning. We'll also quickly talk about the income strategies that you guys will have access to. There'll be shorter term income strategies or income goals. There'll be medium term and longer term income goals or strategies. And I'll tell you exactly the time frames that you want to look at when you want to achieve a certain income goal or when you're applying a certain income strategy. And after all of that, after covering a little bit of groundwork, we'll then go into the step 1, location, and the steps to identify location and the zoning rules for that. And we'll do lots of practical applications for that as well. Not too many practical applications, because I do want to rather quickly get all the steps out of the way so that when we do a practical application, we can talk a lot about putting the puzzle pieces together rather than isolating each step of the way. I want to do the practical applications when we have a full understanding of all the steps so that we can, isolate each step along the way, but then also have a very advanced conversation about how those puzzle pieces fit together. So without much further ado, let's talk about the supply and demand process overview. And as you can see, this is going to be a 3-step process. And here we're just speaking about technical analysis. We're just speaking about the supply and demand process. We are not adding fundamentals in this slide. So just looking at technicals and the technical analysis, the supply and demand analysis, we're going to perform a 3-step process, a 3-step analysis. It all starts with location, then direction, and the 3rd step is what we would call market timing. Now, in all of these steps, we use different time frames to analyze these processes. And generally, you could categorize all of your time frames that you have, depending on the income goal that you're applying, into a higher time frame, so higher time frames, HTF, and you can categorize them into another category called the lower time frames, LTF. So if we speak about location, which we're going to cover today, which is the first step of the process, location is going to be applied on the higher time frame. It's a higher time frame analysis, and we undergo this analysis to identify where, in terms of price, in terms of larger supply and demand zones, price is most likely to turn. The second step of the process is going to be direction. Direction is also going to be applied on the higher time frame. It's a higher time frame analysis to identify, as the term would suggest, the current direction of price. In other words, the trend. And then the last step of the process is what we would call market timing, and then market timing would be applied on the lower time frame. So it's a lower time frame analysis to identify smaller, higher quality supply and demand zones that we'll then use for market timing, that we'll then actually place our sets around our entry, stops, and targets. As I mentioned before in previous lessons, not all supply and demand zones will be zones that we actually use for market timing. We can also use supply and demand zones as bigger context analysis. Okay, what do I mean as bigger context analysis? When we do a bigger context analysis or a big picture context analysis, what we're basically trying to do is we're trying to increase the probability of success. To do that, we need to operate on higher time frames. Whenever we operate on higher time frames, we would look at the big picture context of price. And if we look at the big picture context of price, we would look to increase our probability of success of a certain trade idea. However, if we just get stuck on the high time frames, on the higher time frames, then we have a very high probability of success because the higher time frames, they work really well generally. However, our profitability would be very marginal. We also want to optimize our profitability. And when we look at technicals and market timing, the way we can optimize profitability is to go to the lower time frames. So higher time frames are powerful for analyzing big picture context, and lower time frames are really powerful to analyze market timing. So one we do to increase accuracy and one we do to increase profitability. And in the ideal world, when we do supply and demand, the lower time frame should be in the right context of the higher time frame analysis. Now, let me repeat this one sentence. The lower time frame should ideally be in the right context of the higher time frame analysis. So by the time we will look at step 3 of the process, we'll know about the big picture context of price. We'll know about location. We'll know whether price is at wholesale or at retail, whether price is cheap or expensive. We'll know what the direction of price is. And therefore, we can then put our lower time frame supply and demand zones into the right context of our big picture supply and demand analysis, of our higher time frame supply and demand analysis. So what the multi-time frame analysis allows us to do foundationally, it allows us to optimize both of our key KPIs. It allows us to optimize the win-to-loss ratio through looking at higher time frames, and it allows us to optimize the risk-to-reward ratios by looking at lower time frames. All the steps that I will ever introduce to you, they have a meaning. Okay, we don't just do something just for it to be done. We undergo certain steps of the process with always aiming at something. We'll either aim to optimize our average accuracy, or we'll aim to optimize our average profitability. These are measurable KPIs. These are objectively measurable KPIs. The KPIs would be risk to reward and win to loss ratios. Now, the KPI, the minimum KPI targets that you'll have, that I'll give you from this day onwards, is a 1 to 2 in terms of risk to reward. So every trade that you take should have on average a risk to reward ratio of 1 to 2. So you'll have maybe some trades where you achieve a 1 to 4. You may have some trades where you achieve a 1 to 1. You may have one trades where you achieve a 1 to 2. You may have some trades that are break even, but on average, all your winners, they average out at a risk to reward ratio of 1 to 2. Your win to loss ratio should only be 40-60. Now, this is very conservative. I'm not asking for a lot here, right? I'm basically asking, well, we're going to be right, we're going to be wrong, we're going to be right, we're going to be wrong. Then we may be wrong 2 times in a row until we're right again. If you combine those two KPIs, then you're running a profitable trading business. Today, we're covering location. So when we're covering location, what location is aiming to optimize is the win to loss ratio. It's trying to put our analysis into the right context in terms of where is price expensive, where is price cheap, where is price in equilibrium. If you remember Economics 101, where do I have supply excess, where do I have demand excess, where is price in equilibrium? Therefore, where do I want to participate, in which way? And we're not even placing a trade here, right? We're not talking about risk to reward ratios when we look at location. We're just asking, how can we optimize the win to loss ratios? These are the income goals or the income strategies that we follow usually. There's what we call daily income, there's what we call weekly income, and there's what we call monthly income. Daily income, a synonym for daily income would be intraday trades. Weekly income, you could call them swing trades. Monthly income, you could call them position trades and all long-term investments. All these income strategies underlie the same set of rules. The only difference that you'll find here is the time frames that we categorize as higher time frames and the time frames that we categorize as lower time frames are going to be different in each of those income strategies. So if we look at daily income, for example, we're going to look to find trades that last for a few days or maybe just a few hours. If we look at weekly income or swing trades, then we're trying to find trades that last for a few weeks or maybe just a few days. And if we're going to apply a monthly income strategy, then we're looking to find trades that we can then hold for a few months or maybe just a few weeks. If we're now putting fundamentals as an additional layer on top of that, just really quickly, then we could state the following. We could state that on a monthly income strategy, fundamentals are extremely important. And if we are going to predict price for weeks and months ahead, fundamentals are more important than if I'm just predicting price for a few hours. Makes sense, right? So if I'm going to look at a weekly income style, then since I'm trying to predict price for a couple of days and maybe weeks ahead, fundamentals are going to be important. They're not everything, right? But they are important. As we go into a daily income strategy, though, the lesser importance fundamentals have. Because when it comes to intraday price action, there's a lot that can happen within each and every day that may not be within the overall direction of the fundamentals, right? And so the lower we go in terms of the income strategy, the less importance, the less weight we should put on fundamentals. And the higher we go in terms of our income strategy, the more importance, the more weight we should put on our fundamental strategies that I'll introduce to you. So if you, for example, take a look at this really quickly, just to drive home this point, and down here you have a calendar in March, and what you're trying to do is you're trying to predict price from A to E. So you're basically trying to hold price for 2 weeks and you're predicting a rally. The only way how this could be done efficiently is if you have bullish fundamentals in this case. So, and generally, if you look from A to D here in this graph, the longer the distance in terms of the holding period, the more important are fundamentals. If we look at C to D, for example, which would then just be maybe a holding day of 1 day or maybe even less than that. So a daily income trade potentially. Here, this is a very short distance in terms of the holding period. And so therefore, the less important are fundamentals, or the more important become technicals, supply and demand. So depending on what we're going to do, we're going to have to put maybe a little bit more weight into fundamentals, maybe a little bit more weight into technicals, supply and demand. However, if you look at B2C, which is a shorter distance trade, but that shorter distance trade from B2C is aligned with the longer distance fundamentals. Okay, so, and that is the ideal scenario. Even if you're applying a daily income analysis, you will have two options. You can either trade that daily income analysis from C to D, which may be against the fundamental context. In this case, you can see the move may be weaker. It may be slightly less profitable. However, just because you have bullish fundamentals also doesn't mean you have to necessarily hold a trade for 2 weeks, right? You can also apply a bullish fundamental set of rules into a shorter holding period. And aligning that is ideal. And as you'll see, B2C should have on paper a higher profitability than the C to D, because the A to E is a bullish context, and therefore even the shorter distance trades, if they're aligned with the right fundamental context, that's ideal. However, it wouldn't have to be that way. You could also apply a little bit more weight on the technicals on the shorter distance trades, or on the lower holding periods trades, or on the daily income trades, whatever you want to call them. And then here will be your higher time frame and lower time frame categories for each of those income goals, income strategies, or here we'll call them income streams. So if we're looking for daily income, then again, those are trades that last maybe 4 hours or a couple of days. And the higher time frame, the time frame that we'll use to assess big picture context, step 1 and step 2 of the process, location and direction, will be applied on the higher time frame. And if we are looking to achieve a daily income stream, then we would use the daily as a higher time frame to do the analysis. If we're looking at weekly income, those are trades that we would hold for days or weeks. Here we would apply a weekly time frame when we look at location or direction, step 1 and 2 of the process. And for monthly income, those are trades that we hold for weeks or months. We would apply a monthly time frame for the location and direction analysis. So it's quite simple so far, right? For daily income, we start with the daily time frame. For weekly income, we start with the weekly time frame, and for monthly income, we start with the monthly time frame. However, here's where it becomes a little bit more complex, or things that you have to memorize, or you just have to print out this cheat sheet right here and put it in front of you. These are the time frames that you will look at once we get to the third part of the process, the zoning process, or the market timing process, where we will actually place our sets around. And for the daily, we'll look at 480 minutes, 360 minutes, 240 minutes, 180 minutes, 120 minutes. Generally, you can always look to start at the highest and work your way down. Again, the higher the time frame, the greater the imbalance, as there are potentially more unfilled orders, right? The higher the time frame, the greater the imbalance, as there are potentially more unfilled orders. And as we apply a weekly income, the lower time frame would then become a daily. And notice how if we apply a weekly income, the daily, that is now the lower time frame, was the higher time frame as we apply the daily income strategy, right? So the same we would say here on the monthly income goal. What is the lower time frame for a monthly income was the higher time frame for a weekly income. So you can see that these time frames, of course, they intertwine with the different income streams that we have. Okay, and key to figure out is eventually what time frame is best used for each income stream. That, of course, you can see here, but how does that translate into the real world of trading eventually, where you may not want to distinguish all the time between, well, am I doing monthly income? Am I doing weekly income? Am I doing daily income? Where maybe you can then eventually apply a combination of all those income streams and apply a certain higher time frame and lower time frame, depending on how aggressive or conservative you are. In the beginning, I want you to strictly categorize income streams and look at them almost independently from one another. But the more advanced you become, the more they actually work together, all these different time frames. And the more I want you to look at this as a whole and say, well, this is my arsenal of time frames. Now, if I am very aggressive in terms of I'm trying to get into a trade very aggressively, rather quickly, because of any reason, could be fundamentals, then you could apply a daily income strategy. And if you're more conservative towards, hey, I have more time to position myself, then maybe you would apply a weekly or even a monthly income strategy. Ideally, what we can do, that's maybe jumping the gun a little bit, but ideally, the ideal scenario would look like the following. The monthly, well, let's work from the other way. The daily is covered by the weekly, and the weekly is covered by the monthly, right? That is the ideal scenario, which we'll find very rarely. But if we know that we're in monthly supply on demand in terms of the location, then we have a weekly supply and demand within that, then already I have what we would call a higher time frame coverage. And if I have a higher time frame coverage, then yes, I could look to trade the weekly, but I could also look to trade the daily, right? I could look to trade the daily, then I would maybe do a weekly income goal that I would apply here, because that's where the lower time frame becomes a daily. So you can see they're kind of intertwined. Maybe I'm jumping the gun here a little bit. Don't get too confused. As I said in the beginning, look at them independently, and only as you advance as a trader, only as you figure out what time frames work best for you, and then you'll try to combine all of these different time frames into one strategy that works for you, that then you can adapt depending on whether you're aggressive at the moment or whether you're a little bit more conservative at the moment. So now let's talk a little bit about location, and I want to explain you location very, very quickly before we then go into the practical applications, because I think it makes more sense for me to really walk you through the practical application and explain you why we do certain steps here while I do the analysis, rather than just talking about it theoretically. But there are a few things I'd like to cover here. So location analysis, as we already said, it is performed on a higher time frame. And so you already know, well, a higher time frame then depends. It could be daily, it could be weekly, it could be monthly, depending on your income goal. Depending on your income goal, then you would also expect to only hold a certain trade for a certain period of time as well. So If you're applying a daily income strategy goal and you do the location on a daily, then you would probably not expect to hold that trade for months to come, right? And vice versa, if you're applying a monthly income strategy, then you would not just expect to exit this trade after one day, right? You would look to hold that for longer. What does location do? Well, location helps us to identify where in terms of price is most likely to turn. Okay, by how much price is going to turn, or what magnitude that turn is going to have. That we don't know by simply looking at supply and demand and by simply looking at price. We'll have to add on a lot of additional steps like trend and then also like fundamentals to really figure out what's the potential magnitude of the move that we can expect in terms of a turn in price. However, by just looking at location, what we can identify, or what it helps us to identify, is where roughly in terms of larger supply and demand zones could we expect price to turn. Now, the higher price goes, the more expensive price is. That kind of makes sense, right? What it means is the more willing sellers and the less willing buyers we'll find within the price chart itself. Generally speaking, not always, but most of the time, the higher price goes, the more willing sellers, and the higher price goes, the less willing buyers. That's just how it works. Vice versa, the lower price goes, the cheaper price is. What we can assume, if price is cheaper, we can assume that there are going to be more willing buyers. So the lower price goes, the more willing buyers are going to come into play, and the less willing sellers. So the cheaper the price, the less the willing sellers, and the more the willing buyers that we'll potentially find within the price charts. And so these higher time frame supply and demand zones, they are the areas, the larger areas where we're most likely to find supply and demand excess. So if you remember Economics 101, we would have a supply as well as a demand curve. And the supply and this demand curve, they have an equilibrium. That's where they meet. And they have supply excess, where things just become very expensive, right? And as a result, because things become very expensive, there's not going to be a lot of willing buyers, but there's a lot of willing sellers. There's a lot of people that want to offer to sell something because just it's so astronomically expensive. And the higher price goes, just naturally, the more willing sellers you'll find, right? And vice versa, the lower you go, the more willing buyers you'll find. And eventually, there'll just be an abundance amount of willing buyers because price is just so cheap that no one right in their mind would still sell. And there's just so many willing buyers. So if we're going to apply the same now on the way down, there may be the same amount of willing sellers, and there may still be more willing sellers, right? And price goes down. But then eventually, the willing sellers will become less and less and less until they're completely zeroed out. They're zeroed out here because there are just so many more willing buyers. And that's the origin of higher time frame demand. And vice versa. Price will go up and there'll be willing buyers and the willing sellers, and they'll match. And maybe there are more willing buyers than willing sellers that drive price up. But eventually, there'll be only very little willing buyers, and they'll be zeroed out because there'll be so many willing sellers that come in. And that's usually within areas of higher time frame supply. And it's those areas of higher time frame supply and higher time frame demand where we'll find the greatest likelihood of supply and demand excess. And because that's what eventually will drive price, is the willing buyers and the willing sellers that are left that we don't actually see. We have to find those areas, supply and demand, our four formations within the chart. And once we find those areas, we wrap those lines around. And then we'll take a look at this entire area, which is then going to be our window of opportunity, if you will, because we don't have to look below, we don't have to look above, we don't care. We just care about our window of opportunity. How can we narrow that down? Well, we know on a higher time frame where a supply that would be very high, or a retail price, and we know where there's demand that would be very low in wholesale. And everything in between we can then also divide into certain categories. There's going to be a high and an expensive area. There's going to be an equilibrium, where in equilibrium we know, well, we just don't want to act, right? And then there's going to be a high where, hey, maybe we want to start to think about maybe selling, right? And then there's a time where we're very high, where we're going to say, well, now for sure, let's going to sell. And vice versa, there's going to be a cheap and there's going to be a very low, or we would call that a wholesale price. So what are the steps to identify that? We can follow a 3-step process here. That's very simple. We identify the nearest supply zone on a higher time frame. Now, when I say the nearest, what I mean by that is the first fresh. Okay, we'll talk about freshness in a second, but we'll identify the nearest supply zone on a higher time frame. Then we'll identify the nearest demand zone on a higher time frame. Now, it doesn't really matter which one you do first. You could do demand first, you could do supply first. It really doesn't matter. In this case, we go top to bottom. So supply first, top, and then demand later, second. And then what we do is we divide the entire range from distal to distal into 3 equal parts. And by dividing that into 3 equal parts, we actually get 5 parts. Well, we get a high, an equilibrium, and a low in terms of the entire range, but we also have a very high, a high, an equilibrium, a low, and a very low. So there's going to be 5 parts that make up the location analysis. So step 1 would be, we start at current price, we look above to the left without cutting candles, all the steps that we previously discussed that we're now going to slowly build on in terms of zoning, right? Zoning is something that will follow you for the rest of your trading career. So you better have paid attention before. So now you're going to start at current price on the higher time frame, which could be a weekly, it could be a daily, depending on the income goal. And then you'll just look to find the first fresh supply. Once you found it, you wrap your lines around, starting with the proximal. Then in this case, it's a rally-based drop. It's a rally-based drop. So your proximal goes at the lowest body of the basing candles. Your distal go at the highest wick of the entire formation. You put your lines, you call this supply, and then you move on. You start again at current price. You move down to the left until you find the first fresh demand. There you have it. It's a rally-based rally. Of course, you would have found that explosive candle here, right? And this may have taken you a little bit more time. And then you'll wrap your 2 lines around, starting with the proximal that goes to the highest body of the basing candle, and then the distal that goes to the lowest wicks of the basing candles, including the leg out. And so depending on your formation, you then have your sets of rules in terms of your proximal and the distal. And the default setting here will be the preferred version. Okay, we'll not look at the wider version here. We'll look at the preferred version. Then we'll put our Fibonacci tool from distal demand to distal supply, and we'll divide this entire area, our window of opportunity, into 3 equal parts. And by doing that, I'll get a high, an equilibrium, and a low. And I'll also have a very high and a very low, which we already had from the prior step. That's just the demand and the supply zone on a higher time frame. These are going to be our zoning rules for that. So the leg in is the price action prior to the base, right? Well, let's actually start with the leg out. The leg out for our location zoning, okay, and the location zoning will be slightly different to your market timing zoning, okay? So right now we're just talking about the higher time frame. And you can note that down, that the lower time frame will slightly differ from that. The higher time frame leg out will be made up of only decisive candles. That's fine. You don't necessarily need to find explosive candles on the higher time frame, because as you look at the higher time frame, a monthly, for example, man, finding explosive candles is going to be really, really difficult. Once we find them, that's great, right? But we don't necessarily have to find them. So decisive candles on really high time frames will be enough. Ideally, of course, if we can, explosive candles, but it's not mandatory. The base is just your normal base set of rules. Here, what you've learned to date does not change. So it's made up of one or multiple indecisive candles. And the base, that's the area, as you know, that's found between the leg in and the leg out. And the leg in, as well as you already learned, it's the same thing. It can be explosive, it can be decisive. It doesn't really matter that much. What matters most is the base and the leg out, with the leg out having the biggest importance. And sometimes it's even going to be the case that on a higher time frame, you will not find clear zones. Okay, you may find clear zones, but the only way you're going to find clear zones is by you going back in time 20 years and by you looking below price minus 50, minus 60%. If that's the case, then, well, we can draw in the demand zones, or the supply zones. Well, but good luck with your window of opportunity, because good work, but very likely is that prices never reach our area. So there's a little bit of common sense that eventually we'll have to apply here too. That's why we look at the first fresh. That's one rule that is going to help us to identify which zone we're going to take, because there may be multiple of zones that we can look at. So we'll always take the first fresh. The nearest, if the nearest is very far away, and it's going to take some time for you to then also understand, hey, what is really far, what is not far. If the nearest fresh demand and supply zones are very far away, then you can apply the alternative set of rule, which is everything that looks like a zone or everything that looks like a level is a level. So what that means is you don't care about explosive, indecisive, decisive. You don't care about over isolating all these different parts of our formations. Rather, what you're going to do is you're going to try to visualize the formations. So you're trying to visualize a drop-based rally, or you're trying to visualize a rally-based drop just by the shape visually of the formation itself, not by also looking at what does each part of the formation consist of in terms of the scientific candle analysis. Right, so what we can now do is we can just have a little bit of fun and go into some practical applications. Maybe starting with a weekly income analysis on a stock like Netflix, for example. Now, what I want to do first is I want to do a little bit of an experiment with you guys, and just hold on for a second while I get this ready. That's also something that you can do, by the way, and I'm going to show you how to do that, because backtesting is a very important step of the process. I do want you to backtest and basically look at a situation where you don't see what is going to happen, right? So if you go back into the past, the problem with going back into the past is that oftentimes, as you then look at, well, demand zones and supply zones, oftentimes the problem is that your eyes will trick you to see certain things. Your eyes will trick you to see certain things because you believe in certain things, right? Because you already are seeing how it works out as a result. So a good idea is always to say, well, let's go to time frame, let's go to customize, and here you can put in the last date. So for example, what you could say, well, let's just assume we were in the beginning of 2023. We don't know about January, we don't know about February, and we don't know about March. So I can say, well, now take me to 1st of January as the last date. And now I will not see anything in terms of price. Okay. In terms of, in this case, it would be future price, right? It's kind of, I went into a time machine and I went back into time. And now as I load back time, January, February, March, it's like almost going into the future. And what you now can do is you can apply your set of rules and then see what would have happened, objectively speaking, afterwards. Some zones may have worked, some zones may have not worked. Why is it that some zones didn't work? Why is it that some zones worked? Sometimes it's just a case of, hey, not every zone is going to work, right? We have to be very clear here. Not every zone is going to work. That's why you have a win to loss KPI target of 40, 60 only. Only 40% of all your trades have to be winners. So if you have a sample size of 10 trades, only 4 trades out of those 10 trades have to be profitable. If you then have those profitable trades, if you achieve an average risk to reward of 1 to 2 on those, you are a consistently profitable trader. So all good. You're making money in the long run, right? That's what it's all about. Your revenues are higher than your costs. And so oftentimes it's just a matter of, hey, that one didn't work out. Why didn't it work out? Well, because, I'm just looking at technicals. Not all supply and demand formations are going to work out. That's just how it is, right? However, oftentimes it's also the case of, maybe the quality of the supply zone or the quality of the demand zone was not that great. And when we then speak about quality, now we can go in a lot of scientific detail here, but the most important part about quality is what I've previously stated a lot, is the leg out. By looking at the leg out, because the leg out is the imbalance of the zone. The base is just the base, and the leg in is just the, hey, where is the origin? How do we wrap those lines around the origin? But the leg out is really the one thing that's going to tell us, hey, that's the imbalance. And the bigger the imbalance, the better. Hence, the higher the time frame, the bigger the imbalance. But also, the greater the moves in terms of the candles, right? The more explosive, the more institutional that move, and therefore the greater the imbalance, and therefore the more potential unfilled orders we can still expect in those then origins of those zones. So it's going to be very interesting for you to kind of figure out which one of your zones is working and why. in which one of your zones is not working and why as well. But now let's just start with our location process. And the location process, again, we have 3 steps. First, we find supply, then we find demand. We find the nearest one, right, on the higher time frame. What that means, I'll go into detail after this example. So we'll find the nearest one, the first fresh. And here we just apply our zoning set of rules that you already have access to. So we start at current price. I'm on a weekly chart on Netflix. So the higher time frame here since we're on a weekly time frame, this would be subject for a weekly income analysis. And so I'm going to try and find trades that we hold for days and weeks. And here I'm just looking at Netflix. So we start at current price. Let's put in the steps. Step 1, find nearest supply zone. First fresh, okay? Now, how do I do that? Start at current price, look above current price until I find a candle that is decisive, okay? So if I look above to the left and I find something that is decisive, then you may say, well, this here is decisive, right? If you say that this one is decisive, then that is true. Isolating that candle, it is a decisive candle, right? However, if I'm not isolating the candle, if I'm looking at the surrounding candles, then what I just see is that all those candles have the same size in terms of the same trading range, right? There's no larger candles, there's no smaller candles. They're just all kind of the same size here, right? For at least until here. So they're all the same size. So there's not really a lot of price discovery or a really imbalance that we can see. And so I'm not looking at explosive candles, right? I don't care, but also decisive candles, what they have to be. They don't have to be abnormally bigger, right? But they do have to be large candles. I don't care so much about the wick to body ratio, but I do want them to be large candles. What are large candles? Well, they do have to be bigger than the surrounding candles. And if they're not, if I cannot make them out to be bigger, then it's usually not a decisive candle, right? So there's not a decisive candle because if I look at this entire trading range, it's just as big as this trading range. It's just as big as this trading range here. It's just as big as this. It's just as big as this. It's just as big as, right? And that's, yes, of course, there are like really small candles here in between, but there's not really a whole lot of decisive selling going on here. Okay, so we move on. Until we find a decisive candle. Now I'm here, right? I'm not crossing candles, so I can go here and then look just to the left and cross all these candles or even look to the downside. I really have to move along these candles all the way, covering their entire range, and then I'm up here. And now I look to the left, so you can see where my crosshair is as you now follow my crosshair to the left, and the candle that is going to be there is going to be this candle, right? That's the candle that I have. And I think without debate, this is a decisive candle. I would say this is even potentially a explosive candle. Doesn't really matter that much though, but it's a decisive candle. So I found my decisive candle. So I found my leg out. So I can now get rid of the leg out here. And now I'm trying to find a base and I'm trying to find a leg in. So in this case, we could say, well, potentially this is a rally as a decisive candle. And then I have a lot of basing candles here, a lot of basing candles. And then I have a drop. So I have a rally based drop. What I could also say is, well, this is all a base. And I have my leg in here. And then all of this is going to be my base. And then I would have a drop, base, drop. Regardless of what I'm going to do, I would be fine with either way, right? This one would be okay because it meets the rules here, rally, base, drop. If you said, well, I'm really visualizing this and I'm seeing this here on the higher time frame, drop, base, drop, that's also fine with me. Both would be correct in my books. And so what I want you to do in the higher time frame is, you can see, more visualizing than science. That makes sense. I do want you to apply science, but science with common sense. So not just isolation, but more visually looking at, hey, what's actually happening? What do I want to find? I want to find an imbalance, and I want to find the origin of imbalance. So I need somewhat of a base here, and then I need to find somewhat of a leg in to narrow down the base so I can draw two lines. And the most important is really the leg out. So you really always need to ask yourself that. And so here, if you ask yourself that, then you could have a drop. All of this could be a base. And yes, we can have a decisive candle in the base, right? Because it's just the same size than the surrounding candles. There's not a big size difference in terms of the trading range. And then I have a large candle down, right? So this one is much bigger than these ones. And then this one again is much bigger than these ones. So I have a drop, base, drop. Then I could draw my lines around, but I could also say, I have a rally, base, drop, and I could draw my lines around here. Both I could do, right? Both I could do, and both would be correct. So let's just assume that this is going to be my supply. So what we're going to do is, we're going to now draw our lines, proximal and distal, around the base that we just isolated by putting vertical lines around our leg in and leg out. So starting with the proximal. The proximal goes at the lowest body of the basing candle. So where's the lowest body? Is it here? Nope. Is it here? Nope. It's here, right? That's the lowest body of the basing candles. And then the highest wick of the basing candles, including the leg out, is going to be our distal line. And then I have my supply zone. I can then put my beautiful box around it, around the imbalance. Maybe I extend it now to the left a little bit. And so this is going to be my higher time frame supply. And higher time frame supply is retail, or it's very high. So now we've categorized a certain price area in the chart in terms of whether price is expensive or cheap. In this case, because it's very high, it's very expensive. We're just looking at price, just looking at technicals. This up here is very expensive. So now I'm almost done. I just need to find now demand. Find nearest demand zone. Here as well, the first fresh one. So again, it's just gonna be zoning. I can remove those verticals so I don't get confused. Now I'm just gonna look at current price, and then I'm gonna look at where below and to the left will I have the first decisive candle. Here I could say, well, is this decisive? If you say this is decisive because it's kind of a large candle, it's maybe larger than the surrounding ones, I maybe disagree here. However, if you said this is a, let's say you say this is a decisive candle, then you still need to find a base. You need to look below and to the left, and there's not a base. There's another large green candle. In this case, it's a large green candle. And looking at the body to wick ratio, body to range ratio, it's also potentially explosive. So it's not just large, it's normally bigger than the surrounding candles. And the body to range ratio is also scientifically in line with the explosive set of rules, and therefore you can for sure take this, right? Even if you say this is not explosive, even if you just said this is decisive for whatever reason, it would still apply. Now we can take that. Now again, we need to find a base, and I have indecisive candles here, so I have a potential base here. Now let's visualize what the zone could be here. Well, in this case, I have a rally, base, rally. So where could be my leg in? My leg in could be here, because this is, again, a decisive candle. I have a leg in, then I have a very big base, and then I have a leg out here. So where does my proximal go? My proximal goes to the highest body of the basing candles, and my distal goes to the lowest wick of the basing candles, including the leg out. In this case, we're gonna be right here. And so I have now my demand zone. Higher time frame demand, which is wholesale, which is very low, which objectively measured in terms of price, that is very cheap. We have now an area that's very cheap. Let me just get more space to the right. If ever you have an issue with you not being able to draw further to the right, you can see I can only go to here, right? I cannot go further to the right. You can see it just stops eventually, regardless of how far my cursor goes. So I could go even further. You can see the yellow line just stops here. That's a matter of space to the right. So we need space to the right to draw further to the right. So if I double click on the chart to get customized window, can I just double click to the chart? General, I can add space to the right. And here I could, for example, just for the sake of the exercise, add 100 bars. And if I now go to the right, you can see now I can go further. Right now I can go to here, and I can go to here as well. And of course, I'm dragging the whole thing here, which I didn't want to do. So now I have a window of opportunity on Netflix for weekly income strategy. If price goes up, I want to be a seller. If price goes down, I want to be a buyer. But wait a second. Let's first do step 3. And we also need to check what is freshness. So let's do step 3 first. So now divide the window of opportunity, and that is from distal to distal, into 3 equal parts. How can we do that? Again, with the Fibonacci, Control F, I go from distal of the supply to the distal of the demand. And now I double click on this Fibonacci. And what I now can do is I can add some more inputs. And so, for example, I could add a 33 and a 66%. And now what just happened is we got an additional dotted line here, an additional dotted line here, which means this area was now divided into 3 equal parts. Okay, so now we have from here to here, that's going to be our equilibrium. So within here, what are we going to do in terms of price? Well, price is neutral. It's not expensive. It's not cheap. It's neutral. We don't participate. We wait. If we look below price, from here to here, price is going to be cheap or low or cheap. And as I look at expensive, there's only going to be a very small part of it, which is from here to here. That part is going to be my high or expensive part. So now I have my window of opportunity, and we could even make this as well, in this case, red, right? Because this is also high, and we could make this also green or dark green, and then we make this dark red maybe. And now I have a window of opportunity. I have areas in the chart where I can objectively say, is price expensive? Is price cheap? Everyone is always talking about buy low and sell high. What the heck does that mean? How do you objectively measure whether price is low or cheap, or whether price is high or expensive, depending on also your income goal? So right now we're working on weekly. That analysis may be completely different on a daily income strategy. So what you perceive as cheap, depending on how long you want to hold something, will depend on your income strategy, your income goal. If you want to hold something for weeks, then you need to look at weekly timeframes. If you just want to hold something for days and less, you can look at dailies. And if you want to hold something for the long run, you gotta look at monthly timeframes. So here we're looking at weekly, a weekly analysis. We've got a window of opportunity. And in this case, what we can say is that our supply and demand zones, they are definitely the first ones because they're the first ones that we found. But are they also fresh? Well, so far, they are still fresh. because price has not tested the zone on the preferred version. Okay, so freshness, what you're asking is, has price tested the zone identified? If price has tested the zone that we identified, if price already pierced into this, that's generally not fresh anymore. The higher time frame location rule for freshness is going to be we will allow a test of smaller than 25% of the entire zone, which means that if price goes into the zone and it tests it by more than 25%, so a quarter of the zone, you can eyeball that. You don't have to put a lot of, you don't have to take the measuring tape out. You can just eyeball it and say, if price is testing it by more than 25%, and for example, you would see this wick here that you see right here, that wick would go to here and you would find the zone, then you would say, hey, price has tested the zone by more than 25%. It's not fresh anymore. What I have to do is I have to continue looking above and to the left and then find new supply. Okay, so in this case, however, the wick stops here. It doesn't pierce into the supply area. And even if it pierced into the supply area, it could pierce so slightly, still fresh. It's tested, but it's not tested by more than 25%. However, if the wick goes into here, then it's like, okay, why do we do that? Well, we do that because we want to make sure that there's still unfilled orders and willing sellers here. The more times we see a test into the zone, the more times price goes in, the more the willing sellers are going to be reduced. And eventually we should then see a breakout in terms of price zone. So we want them to be fresh and by as much as possible. And on the higher time frame, that's our rule. We will allow a test of 25%, but not much more. And we can just eyeball that. You don't have to take the measuring tape out. So now the beauty is, what we can do is we can just look at our time frame, we can customize, and we can now go 1 month into the future. Now let's go into February. And what we see is, price is going into our zone. Okay, price is going into our zone. So price is going into the zone where we said we wanted to be a seller, right? Now, at this stage, if we had placed an entry here and a stop loss here, then to achieve a 1 to 2, where does price have to travel? Well, price has to travel this size of the box times 2. So here I'll have a 1 to 1. And then here I'll have a 1 to 2. So price has to travel all the way to here for me to reach a 1 to 2, which I need on average to be profitable. So what I'm saying here in location is, well, somewhere here are willing sellers and price may turn. So far, price hasn't turned yet. But what I don't want to do is I don't want to put a sell here and an entry and a stop loss because, well, even if it works out now, then price has to travel such a large distance for me to even achieve a 1 to 2, which makes this trade, even if it works, profitable, right? So we have to do both. We have to find trades that are accurate And the trades that are accurate, they also need to be profitable. When we look at location, what we're optimizing, as you can see, is not the profitability, right? Because most of the time we'll find large areas, and with large areas comes less profitability, but with large areas, there's a higher probability of success, a higher accuracy. So let's continue again another month. See if the sellers are going to come in eventually. We now go into the 1st of March. And now we can see from somewhere up here, price now finally turned and price is moving lower and lower, right? So now price is here and price has reacted to the supply just like expected. But even if we had traded this, it would not have been profitable at all. And even today, we have not even yet achieved the one-to-one yet, right? So no way we would set a trade like this. And we're in the higher time frame. We're just identifying where is price expensive, and then later on, as we then move into the lower time frame, we can then look to, hey, where do we want to place those lower time frames? And then potentially and ideally, those lower time frames that we then find, they should be within the right context of price. Okay, once we go into step 3, then the lower time frame should be into the the lower time frames should be in the right context of the higher time frame. So if I'm looking at supply zones on now the lower time frame, which then would be a daily, if I now would go into the daily and I would find maybe supply here, maybe I would find a drop base drop here on the daily, where then I can wrap my entry around. I would be entering here and I would have my stop loss above, and my stop loss would be here. Now all of a sudden, my entry and my stop loss, my zone that I'm actually trading, that I'm setting, is a lot smaller. And so if this is my risk now, then price has to travel once, 2 times, 3 times. So already +1, +2, +3, already I'm roughly achieving a 1, 2, 3 where price is at the moment, if I had found a lower time frame. So the job for us is, as we go into the lower time frames, is to put them into the right context of the higher time frame. So we cannot start with the lower time frame, right? Because if we start with the lower time frame, we don't know, well, is it in the right context or is it not? We have to start with the higher time frame and then knowing, hey, where's very expensive, where's very cheap? And so therefore, where do I want to find those lower time frame demand zones? Like here, for example, I might find the lower time frame demand zone in the daily that looks like this, a rally-based rally, and I can further pinpoint the origin of imbalance here. And therefore, I would trade that accordingly, right? Now, if I now looked at this analysis, right, and after the fact that this now has happened, this zone, the supply zone, is not fresh anymore, because price has pierced this level by more than 25%, right? And so if I now look at the analysis again, then I would have to say, well, this is not fresh anymore. I cannot take this. I have to remove 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 all of this, right? And I have to start from scratch. Well, this would still be fresh, but now that price has moved for 2 months, what we need to do is we need to redo and reevaluate the chart. We need to reevaluate whether this is still considered cheap, very cheap, because things can change, right? Things can change, especially in 2 months' time. So now we're gonna go to today. And what we're gonna do is we're gonna reevaluate. First, we're gonna find supply. So we're gonna look above price to the left to find a decisive candle, a large candle. Now, this is a large candle. It's larger than the surrounding candles. And I could visually see a clear base. Here's an indecisive candle. And so I could say there's visually a rally-based drop. I could also say there's a drop-based drop. Both I would be fine with. If you say there's a rally-based drop, then you would have your leg out here. You would have your leg in here. These would be your base. Again, we have a decisive candle potentially in the base, but the decisive candle is not large, right? It's the same size as this candle. It's the same size as this candle. So it meets the decisive rules in terms of body to range, but it's just a small candle in the context. So my proximal goes at the lowest body of the basing candles. My distal goes at the highest wick of the entire range. Now I put my box around it. This is now very expensive again. And now I want to find demand. So I look below price until I find a decisive candle. Now I may have found a decisive candle here. And what I can see is overall there's a large move. So there's not just one decisive candle, there's a large move to the upside. And so even if this was, in this case, made up of smaller candles, just a lot of them in a row, for me, it's the same as if this is maybe two bigger candles or 4 candles. For me, it's a large rally. Okay, I visualize the big picture. I am on the big picture. I'm trying to understand the bigger picture context. So I look at the candles in the overall context. And for me, that's a clear rally. Then where's the base? Well, I have a base here, and then I could have a drop base rally. I could have a rally base rally as well. Both would be fine. Let's say we have a drop base rally, drop base rally. Then my proximal goes to the highest body of the basing candles. My distal goes to the lowest wick of the entire formation. By the way, you do not have to color these areas like I'm coloring them. Just one color is fine. I just want to paint a picture for you. So this is very cheap. So now I had a very cheap before down here. Now I have a very cheap here. Now this is still fresh. This is still fresh. So I take the first one. I don't care about this one anymore. I could leave it in, but if I now go to step 3, I go from distal to distal for my nearest supply, my nearest demand. And I'm going to add again the 33 and the 66%, which divides this into 3 equal areas from 0 to 100, distal to distal. I just put the entire range, 33 and 66%, divides this into 3 equal parts. And now again, I have an equilibrium in the middle. I have a low right here. And again, my expensive would be in between those two. Or high. Now, depending where price goes, I want to be a buyer or I want to be a seller. In this case, as price is moving towards demand, what do we want to do? Well, we want to look to buy, right? How do we buy? How do we set? How do we place a trade? We don't know that yet, as we're just talking about the first step of the process analysis. But what we do know is that the lower price goes, where do we really expect price to turn from here, right? How much is the magnitude going to be, meaning how big is that rally going to be, and how long is that rally going to stretch for? We need fundamentals to answer that, really. However, just looking at price, we can say that down here, if we have bullish fundamentals, we could predict price to turn down here. So even if I have bullish fundamentals as price is here, just because I have bullish fundamentals doesn't mean I'm going to buy here, right? It doesn't make sense. I want to time the market. I don't just want to buy in equilibrium. So I can be right and the trade can be unprofitable, right? I can be right and achieve a low and below average profitability. However, I can be right and I can be really profitable. So what we want to do is we want to combine the, yes, that we want to be right, but we also want to be profitable. So there's again a trade-off between profitability and accuracy. And usually that trade-off between accuracy and profitability, there's a war going on between the two. So I can be right a lot of times, and you will find that on the higher time frame, especially in terms of looking at the fundamentals and where does price go from A to D really in the long run, right? Where does price go? That's really easy to do. That's much easier to do. What's really difficult to do is then also to find a good entry, a good stop loss, to time the market efficiently so that this trade is profitable, so that you can be a profitable trader in the long run. That's really the difficult part of the story, because while that's based on technicals, and we'll talk that when we talk about that a lot when we talk about the step 3 of the process, but while this placing of the trade, a set, is based on technicals, on supply and demand zones, and in theory thereby it should be very objective, it's the most difficult part of the analysis. Why? Well, yes, it's objective on paper, but it cannot be objective because that's where the money comes into play. That's where the subjectivity can come into play. That's where one may say, well, I'm more aggressive. The other says I'm more conservative. One may say I use a daily income time frame. The other says I use a weekly income time frame. And so when everyone says, well, trading is so easy, and especially if we do it on technicals, because technicals are so objective, I would say, well, how can placing a trade be objective when there's money on the line? When there's money on the line, very rarely are we speaking about an objective situation. We should be as objective as possible, but within that realm of objective technicals, there can be an aggressive objective technicals, there can be conservative, right? There can be weekly income, there can be daily income. And there can be different styles depending on what type of a trader you are. And so then oftentimes you'll find that traders, good traders within the campus, and mentors as well, like Tobias, like Clemens, like Bern, and myself. We may have the same idea about a certain market, like, hey, we want to buy Dow and we want to buy Nasdaq. But how you approach that market timing is slightly different between how I approach it to how Bernd approaches it, how Toby approaches it. And so the more you learn about our way of thinking in the market, is you'll understand, even though everyone says fundamentals are subjective and technicals are objective, actually it's the other way around. You'll find that the fundamentals is actually the thing that's objective, where we can all agree on, yes, we're bullish. Of course, everyone sees that we're bullish. How can we see that we're bullish? For example, the commercials, the users and producers are buying, right? They're accumulating heavily more than they have in the past years. So we see that the institutions are buying, they drive the market. So of course we're going to be bullish. So you and I, we can both come to the same conclusion. But then when it comes to market timing, you and I, we could differ. So what is objective and what is subjective is actually contrary to what everyone is taught. And also what we talked about in the beginning, in the first lesson, where we said, well, what are technicals? Well, technicals are objective. They're universal. They're powerful. Yes, they are. We use them for market timing because the analysis on paper is quite objective and universal. However, within that realm of objectivity, as money is on the line, and then FOMO, and then fear and greed, and aggressive versus conservative, and different time frames, that's actually the subjective and difficult, very, very difficult part of trading that we need a lot of practice on, and where we need to gain a lot of confidence on. And the other part, the fundamentals, that actually everyone is saying, well, fundamentals are subjective, hence we should maybe stay away from fundamentals because anyways, who knows? That's the part that if we do it right, it's the objective part. It's the easy part. It's following an indicator, and if the indicator does something, we know that, we want to buy or we want to sell. So maybe getting a little bit ahead of myself here, but oftentimes that's just something that I have to do at certain points, because I have to get ahead of myself, because A, I have to tell you what awaits, and B, I don't like talking about certain steps in an extreme isolated way, because nothing that I'll ever show you isolated works very well. I cannot tell you one thing completely isolated apart from the strategy optimizer itself, which even that on its own is weak, I would say. It's better than other tools, but it's the strongest tool isolated that we have, the strategy optimizer. However, everything isolated is a bad idea. Hence, we do a multi-time frame analysis. We do technicals and fundamentals, and we use each part of the analysis to either optimize profitability, the risk to reward ratio, or we use a step of the process, a part of the analysis, to optimize the accuracy, the win to loss of our trades. If I do something and whatever I do does not optimize either KPI, does not optimize either of the two things we want to achieve, profitability and accuracy, then I don't have to do it, right? We want to be efficient in our approach. We want to be using our time as efficiently as possible. And so we're not just doing things to do things. We're always doing things, and you always have to ask yourself, when you do something, when you apply something, you always have to ask yourself, me applying that, what am I aiming to achieve? And therefore, the way you look at this analysis may also slightly change a little bit. The more you, I'll write this down. the more you aim to optimize probability of success, or in other words, accuracy, or your win to loss ratio, whenever you look to optimize that, that's bigger context, higher time frame, really looking at things from the top, right? Not isolating, looking at detail scientifically, really zoom out or bird eye view, looking at the bigger context of things, fundamentals. And so bigger context, higher time frame, right? Technicals can also be used to get an understanding of, hey, what is expensive and what is cheap. And so not all supply and demand zones are going to be used for timing the market. Then the more you aim to optimize your profitability, in terms of your risk to reward ratio, the lower the time frame, the more scientific, the more accurate, the more we want to zoom in, and the less we need fundamentals to do that, because we're speaking about market timing here on profitability, and we're speaking about understanding the context of price, analyzing price and fundamentals. And that is why we need different time frames. We can't just look at one time frame and achieve an understanding of price where we know everything that we want to know. So what I would do is I would call it a day for today. And then for next time, we'll already introduce direction, because what I want to do, rather than now doing 10 examples of location and zoning, this is something that I showed you can do yourself with back testing, going back in time, and then that allows you to look into the future. That allows you to get a glimpse of what the future has in store for us if we just draw in higher time frame locations, supply and demand areas, how good you are already at drawing them in, why they fail, why they may hold. And you can do that on your own. And what I want to do is I want to quickly do it, but every time I do it with you, I also want to talk about the next step. I want to talk about, okay, now we talk about direction, and this is how direction flows into location. This is how we combine location and direction. And then this is how we add on fundamentals, right? I want to quickly get towards putting the puzzle pieces together so we can talk about, so I can get ahead of myself. And me getting ahead of myself will not be that vague anymore. It will be more practical too. So I'll stop the recording here. Feel free to stay online and ask questions. If you do so, I'll stay online. If not, thanks for watching. Happy and safe trading, and ciao.